Just 1 year ago, houses were flying off the market at a record pace. But fast forward to today, and the market is at a standstill. So what's the reason for this drastic change? The main factor is the increase in interest rates. Due to the government printing off a record amount of cash during COVID. Since COVID started, we've actually printed off 55% of the money that is in circulation currently. 55% of the money that you are holding in your bank, your wallet, your house, is been printed off in the last 18 months. Inflation was easy to predict. To counteract inflation, the government has two options. They can raise interest rates. That's their first option. This will happen in the next 2-3 years. You'll see loans go from 2%, 3% interest rates to 6, 7, 8 maybe even interest rates. This will freeze the market. Second thing they can do is produce more products. Both individually would make inflation. Combined, they're gonna make hyperinflation. And in order to combat inflation, the Federal Reserve has to raise interest rates, basically making it more expensive to borrow money. This has a direct effect on the housing market, as people's purchasing power is decreased. A 1% increase in interest rate takes away about 10% of the buyer's purchasing power. This means that fewer people can afford to buy houses, leading to a slowdown in the market. Buyers are now facing 7% interest rates versus 3% a little over a year ago. This means that a $300,000 house used to cost a monthly payment of $1,788 and now would cost $2,482 monthly. If you can only afford $1,788, you can now only afford a $215,000 house. Sellers also have to adjust their strategies in this market. Some may drop their purchase price to attract buyers, while others may choose to pull their house off the market and rent it out instead. It is important to note that this market is different from the 2008 crash, as many sellers have equity in their houses and don't necessarily need to sell. This means housing prices may not drop as dramatically as they did in the past. My advice is to get educated on your market and only buy a house if you're able to stay in it for at least 7 years and can afford the monthly payments with the high interest rates. Also, be patient. There are still deals out there, and sellers may be willing to negotiate on price or even add value to the property. Although interest rates are high, there's still money to be made if you look in the right places. Check out my video on 2 types of rich people to know what to do with your money before you spend it.